everybody. Thank you so much for joining us today for one of our weekly webinars here at the Retirement Group. My name is Sam, and I'm in Client Services here. I moderate these weekly webinars for you. In just a minute, we're going to be joined by one of our senior advisors here. His name is Tyson Mavar, and he's going to be answering some of the most asked questions we've been receiving lately from Fortune 500 company employees. Before Tyson comes on, I'd like to very quickly remind you that although we work very closely with both active and retired members of several Fortune 500 companies, the Retirement Group is not affiliated nor endorsed whatsoever by any specific company. We are a completely independent group of financial advisors, so please keep that in mind. And throughout Tyson's presentation, I will be entering some very useful links into the chat, so please pop that open and take advantage of those resources. They will guide you to several different places, one of which being the complimentary cash flow analysis that we offer here at TRG. You can make an appointment to speak with either Tyson himself or one of his colleagues to have that run for you to get started on your retirement journey. So take advantage of that. And without further ado, I'm going to now turn off my camera so Tyson can get started on answering those questions for you. Hey, Tyson.
Hi, Sam.
Hey.
Thank you, folks, for attending our webinar series today. My name is Tyson Mavar. I'm one of the retirement specialists here at the Retirement Group. And on today's webinar series, we're going to go over some questions that we've been receiving both from clients and prospective clients related to 2024, the outlook, as well as the election that we have coming up and the impacts, the potential impacts of that on financial markets and on specifically people's retirement portfolios. So we went over 4 questions that we thought were pretty good questions that have been coming up a lot just in this last few weeks. The first question was, how do election cycles influence the stability and performance of the stock market, and what can retirees do to mitigate potential risks during these periods? Well, we actually, on our last webinar series, pulled up a chart of the S&P 500 returns in the year of an election, as well as the year after an election, going back all the way to Lyndon B. Johnson's election back in the 1960s. And while the results varied, one thing that we found was that both election years as well as years after an election typically had positive results, and they weren't too far off from the long-term average growth rate of the S&P 500. They were about 8 to 9%. Now, of course, there was wide fluctuations telling us that there's not a whole lot of predictability whether it's going to be a good year or a bad year. And there was also positive results both when Democrats were elected as well as when Republicans were elected. But as you can imagine, the implications of both congressional elections as well as presidential elections, there's going to be some implications on fiscal policy as far as taxation goes, as far as subsidies and government spending goes, and also as far as regulations go. And these could have an impact on your portfolio depending on the sectors you're invested in, the asset classes you're invested in, bonds, stocks, cash, annuities. And so these are things that we look at when we're reviewing a portfolio in preparation for any change, including an upcoming election. And this one being a rather big one because we have both it's a presidential election as well as many congressional seats available. Question 2, how can I approach diversification in my portfolio considering the possible shift in economic and fiscal policies after an election? I think the key word here is diversification. Because we can't predict the future, there's a lot that could change as a result of the election. We talked about some of the issues with fiscal policy, monetary policy, regulations. We diversify to protect against the uncertainty. And this is even more important in an election year or a year where we have some potentially big changes about the future. And so this is a good time to review portfolio, make sure you're well diversified. You're not overweighted in any asset class, in any sector, in any region of the world. And this becomes especially important for somebody who's either approaching retirement or already in retirement and requiring cash flow from their portfolio to be well diversified so that we are not too reliant on any one sector or asset class to make our retirement a success. Question 3, in periods of escalating inflation, what underlying reasons cause value stocks to outperform growth equities? We talked a lot about this in our last value equity and value investing seminar series. And this is a complex question, but I'll try to answer it in the simplest way possible. Typically, growth stocks are stocks that people are willing to pay a premium for based on their current earnings or current fundamentals, which is based on an expectation of growth on such fundamentals such as earnings, revenue, asset growth. Value stocks, typically their price is predicated on current earnings and no expectation necessarily of future growth. Well, when interest rates are low, it's good for a growth stock because the future earnings are going to be discounted at a lower discount rate. However, as interest rates rise, this is going to increase the discount rate that we are discounting future cash flows or future earnings from a company back to a present value. So typically the present value of stock is going to fall, especially when those earnings are expected to grow at rapid rates in the future, which is why people were willing to pay a premium for that stock in the first place. So value stocks don't get hurt as negatively as growth stocks, typically in a rising interest rate environment. And an ancillary issue on this is that sometimes companies that are growing have to have more debt in an effort to grow their companies, and higher interest rates are also not good for companies that carry more debt. So this is something that we are focusing on as value stocks for our clients, especially in the retirement portfolios, to help protect the portfolio from a rising interest rate environment. And also value stocks historically have done better than growth stocks. And while there has been some very good years in the recent 10 years for growth stocks, we're trying to focus more on value stocks or overweight value stocks in our clients' portfolios, especially those that are already retired. Question number 4, how might the upcoming election results influence the interest rates on our pension plans? And what steps can we take to safeguard our pension earnings against potential fluctuations? So this is really going to depend on what type of pension plan you are on or your company offers. The main two that we differentiate on are defined benefit plans or formula-based plans compared to defined contribution plans, typically called cash balance plans. And my guess is what this person or this group of people in particular were concerned about is a defined benefit plan. In a rising interest rate environment, typically the lump sum value of a defined benefit pension plan is inversely correlated with interest rates. So when interest rates go up, the defined benefit lump sum goes down. Now, every company observes this differently. They use different interest rates to calculate the lump sums. They have different look back periods. They have different evaluation periods. So this is something that we work specifically with each one of our clients, depending on which company they come from and what pension plan they have. But the best thing you can do is to run lots of scenarios on your retirement cash flow analysis. This is something that we do complimentary for anybody that's willing to spend some time with us, whether or not you're a client yet. And we will run multiple scenarios of different retirement timeframes, different benefit payout options, such as the annuity option on your pension in comparison to the lump sum, and also different interest rate assumptions in an effort to stress test the plan and say, well, if interest rates do go up another 2% and I'm planning to retire in 3 years, what does that do to my retirement plan sustainability? And what can I do to make up for the potential detriment that resulted from interest rates going up on my pension? And sometimes it means saving more. Sometimes it means working longer. Sometimes it means restructuring or reallocating your portfolio. And there's a lot of things that we can learn from this exercise. So best advice I have is to run our complimentary cash flow analysis, speak with one of our retirement specialists, especially one that specializes in your company's plans if we have one. And we'll do our best to evaluate what's going on in the current environment as it pertains to your plan, and what may be some things that we can consider to improve the sustainability of your retirement plan and reduce the risk of running out of money in retirement. Those were all the questions that we wanted to go over, but we just want to remind everybody of this staggering statistic that 74% of Americans over the age of 50 don't have a written plan for their retirement. And we believe this is just unacceptable, folks, especially when there's a variety of companies, including our own, that will run one for you for free in an effort to get to know you and improve their probability of earning your business. We're happy to do this for you, folks, if you're willing to spend some time with us. So take advantage of it. There's a variety of ways that you can reach us. You can call us at the home office at 800-900-5867. You can email us at info@theretirementgroup.com. And whether it's just a quick 5-minute consultation or we actually run a cash flow analysis for you, we strongly encourage you to spend some time with us, especially as you approach retirement, and especially as many things have changed as far as the tax code, interest rates, and now an election that could be very interesting as far as changes coming in the next 1, 2 to 10 years and how that affects your retirement plan. So spend some time with us. We're happy to spend some time with you if you're willing to schedule some time with us. Here's a couple ways to do that. And with that, we're going to wrap it up today. I want to thank everybody for joining our webinar series today. Please, if you have questions, let us know so we can add them onto a future webinar series or have a one-on-one conversation with you. Everybody, hope you have a great rest of your week, and we hope to talk to you all again very soon. Thanks again.